I'm Mr. Flawless, the currency trader and a trading coach at Flawless Executions Trading Hub. And today, with this educational episode, we are going to talk about why we had this massive downtrend in the EURUSD pair from mid last year to this very moment. And if we could have used our fundamental analysis and data in predicting this massive trend. So, as we are going to use this news feed and the chart to elaborate and explain this concept, please don't forget to subscribe to our channel and also hit on the notification button so that anytime we upload another video, you'll be among the very first people to have your hands on it. Stay tuned as we move on to the technical charts. Hello, Mr. Flawless, still here. You are welcome back to the technical chart and how we can use our monetary policy tools and also our fundamentals in predicting this massive trend here. And this trend we are talking about, this movement consists more than 1,500 pips, and it started somewhere May 2021, somewhere May 2021, and I'm telling you, could use our fundamental analysis in predicting this whole trend from this end to here, from last year May to this year to this very moment. And this trend I'm talking about, as I've said earlier, is more than 1,500 pips, and we can use our monetary policies divergence, as I used to say, in predicting this market direction. And without wasting my time, let's learn something about the divergence of monetary policies that I always use to say. So now let's use this diagram to understand the monetary policies that I always talk about, and that's what I always say that is the driving force, or that gives value, a potential value to a currency. And before we move on to this chart, to move on to this diagram, this line or ray going up, this one representing the USD, this one is the euro. And in May 2021, as we were taking ourselves from the pandemic effect, economies were doing a lot of things, and the things that the economies were doing, if one economy find itself doing or going up and another economy find itself not doing anything at that particular moment, we have this divergence. And if what the first economy is doing, another economy is doing the opposite of that, we also have a very huge divergence, and that divergence strike all the way from that end to here. And this whole divergence is one going up and another one going the opposite way, and this short one will be one going up and the one going the neutral way. And at that very moment, the US dollar, or the Fed, or the US economy, the US people, United States people, they were having high vaccinated rate because they have vaccinated a lot of their adults or working force people, as compared to the euro. The euro people have a very low vaccinated rate comparatively. And also the US dollar, or the US people, were looking to start tapering. The third one, they were coming out of lockdown because they were having a high rate of vaccinated people. They were not afraid of letting people out, and they think because they are vaccinated, they are not going to escalate the spread of the COVID-19 virus. And as compared to the Edo people have a very low vaccinated people comparatively, and they were full in lockdowns, and this depicted that the economy was still in shambles. But here in the US, the economy was pulling itself out from the shambles, and they were looking to make some gradual changes or some gradual steps towards better economic levels. So at the time, the US dollar was looking to revive its economy based on the vaccinated people, and also based on letting people out of lockdowns. The Euro people were not doing all these things, and they were neutral, and this created a divergence in their monetary policies. And also the US people were looking to start tapering, and tapering simply means printing of money into the system, and this printing of money into the system will produce a lot of money into the system, and this will make the money in the system, or the usable amount in the system, very much, and this will lead to inflation. And when inflation is more than 2% annual target of most of the central banks in the world, they will start to hike interest rates. So as the dollar was looking to start tapering, the euro was not looking to start tapering, and tapering is also a step towards rate hike. So as the euro people were not looking to taper, they were still printing in money, and they were still devaluing their currency, as the US dollar was looking to add some value into their currency, and this creates this huge divergence that drove the euro USD pair downwards, because the US dollar was the one that was valued, or was the one that was appreciating from that end to now, and from that end this was what was happening. And at this moment the US dollar have started, or the Fed have started rising interest rates, and the euro are yet to put a stop to the quantitative measures, quantitative easing measures. They are still in their quantitative easing mood, while the US people have done, or they are done with the quantitative easing, and have even moved a step further to increase interest rate, because their inflation target is well above the 2% annual target of Fed, or United States Central Bank. So this creates a nice divergence for speculators to base their analysis on this and trade. And I will show you some few news that projected that the Fed was really looking to taper and increase, or move a step closer to rate hike. As you can read, the Fed sees Fed sees two rate hike by the end of 2023, inches towards taper. So here they were looking to hike interest rate, and before they can hike interest rate, they need to start tapering. They need to start reducing their bond purchase, reducing their quantitative easing, reducing the amount of money the Fed was printing into the system, and they have to reduce it gradually, so that at the point they will get rid of the quantitative easing. And once the quantitative easing is over, they can put a step, or they can start to hike rates. And the Fed was doing all this, and at that moment the European Central Bank, ECB here means European Central Bank, they were not giving any news, any outlook of them getting or stopping their quantitative easing program, which will give them the stand, or a chance for them to hike interest rates. So they were cool, and they were still happily printing money into the system, and their speeches, their news that they bring to the market was always dovish in the sense that they were not looking to hike any interest rates. And so this divergence, or this monetary policy by these two central banks, create this divergence that drove the US dollar up and the euro down, and this create this massive movement, more than 1,500 pips for this movement. So also somewhere we also get this news also from Bloomberg, and this also news was saying Fed officials saw taper starting in mid-November or mid-December. So they projected that the Fed was going to start to taper, start to reduce their bond purchase from mid-November or mid-December, and because of that the market were pricing. So they have something that we call, you have to buy the rumor and sell the fact. So the market always buy the rumor. So all these news were going on. This market, or these speculators will look at, oh well, the Fed is about to taper, and they will get to know that this news is not just a rumor. They have some basis, and they will predict the value of the dollar, because the dollar is going to have demand. There's going to be more demand for the dollar, and the dollar is going to increase in value in the near future, and they will speculate on that, and the big boys and the smart money will start buying the dollar and selling the euro, buying the dollar against the euro. And this brought out this huge downtrend in this chart. So this is the reason why we had this massive downtrend from mid last year to this very moment. Thank you for watching, and I will see you soon. Don't forget to subscribe.